Hello, and welcome back to our Partner of Choice podcast, where we share insights from the RBC Capital Markets team on the trends shaping global markets today. I'm your host, Janet Wilkinson, Managing Director and Head of Global Markets Flow Sales EMEA. And today I'm joined by Eric Gerth, CEO of RBC BlueBay Asset Management, which represents RBC Global Asset Management outside of North America. Eric, it's great to have you with me today.
Well, Janet, great to be here. Thanks for having me.
Super. So let's jump straight in, Eric. RBC's asset management business has grown a lot in recent years. Today, you manage our CAD $700 billion globally and sit amongst the leading asset managers in Europe, particularly in fixed income. You became CEO of BlueBay in 2017 and have overseen a remarkable period of growth, including the integration with RBC. What would you say have been the key drivers of RBC BlueBay's success over the years?
Okay, well, thanks, Janet. I think I can break it into two pieces, kind of a pre-integration and post-integration. So the pre-integration, what were the fundamentals, and the post-integration, where do we get acceleration through the integration with RBC? So I joined the firm in 2000, at the end of 2012, and was responsible for business development for BlueBay, and then became CEO in 2017. And what I did, starting with the business development strategy and then executing and accelerating as CEO, is look at what were the fundamental building blocks that we had as an organization, where would they fit? So where could we focus our strategy? Because what I noticed with many small firms, oftentimes they try to boil the ocean, assuming that just because there are resources or dollars out there to be won, that they're going to get their piece of the pie. It's usually never the case. It's usually a zero-sum game. So the first thing I looked at is BlueBay was based here in the UK, and as a result of that, the proximity to clients in Europe and the view of the world, Europe out, or UK out in this space, but definitely Europe out, was going to be a competitive advantage versus many of the North American peers that we come up against, especially in fixed income. And BlueBay was a fixed income specialist. The second, and I picked this up almost happenstance, is that I could see convergence taking place. This is going back to 2012. We've seen acceleration in the last couple of years between alternative and traditional asset managers. And so alternative managers wanted to move into channels that they had in the past not really accessed, especially financial institutions. And on the traditional asset management side, traditional asset managers wanted to gain access to asset classes that they in the past have not been privy to or had built out internally. So in both cases, there were going to be some challenges there, and we were uniquely positioned because the foundation of the firm, we were built as an alternative multi-strat firm. And then we looked at the importance of creating a kind of multi-generational organization, looking at many hedge funds not having that ability to do that. It would live and die with the principles of the organization. So we could see the demand picking up for long only as interest rates were coming down, use the fundamentals of alternative investing, but put everybody on a single platform so that you had cultural alignment there, and also ensured that we had the appropriate acumen in operations and in sales to be able to support both long only and traditional. As we've seen that convergence take place, it's put us in an excellent position to compete across the spectrum. The next piece was really a play on, do you make your bet in Japan or do you go after China? Having worked in Singapore previously and worked across markets, including Japan, going back to 2002, I noticed that one of our first offices at BlueBay was opening up. We opened up in Japan. So while the world was moving to Asia, and having worked in a joint venture there and having access to it, I said, let's put our chips in Japan. And the reason for that is the regulatory environment more organized, depth of their capital markets, as well as access to senior decision makers, much more developed and centralized, all of it taking place typically in Tokyo. So by making those bets, we've been able to have a very focused business. And as the world has shifted now from China with the decoupling back to Japan, we're about to celebrate our 20th year there. So we've got a long-standing presence in Japan, a lot of acceleration. It's our second largest market. And Europe, which tended to be, again, with proximity to clients and the type of products that we have, also our strength. I'd say post-integration, the two things that have really helped us quite a bit. First, culture. There's a lot of similarities between the RBC culture and BlueBay culture in that, in both sense, collaboration was very important and a certain sense of humility. And so that sense of humility meant we'd put our clients first. It also gave us the ability to create a platform that others could succeed. And we use, everybody talks about growth mindset now, but we really look at it as the ability to continuously learn. And a growth mindset is one to be humble enough to know that things go wrong, use it as a learning opportunity instead of an excuse to blame somebody. And I think that culture, which thrives inside RBC, was also something that we had at BlueBay. And being able to integrate those two businesses, typically when integrations takes place or acquisitions, it all goes wrong on the culture front. And be able to leverage the culture of RBC and then the leverage that comes with the size and the scale of the organization has made a massive difference to us. So I would say those are some of the things that I would attribute to our success to date.
Thanks, Eric. That's quite a remarkable story from 2012 up until now. And you touched briefly on it when you spoke about pre-integration and the move across alternative and long only. So maybe just doubling down on that a little bit, what would you say is different about your approach today versus the early years of your career?
Okay, so so if we take it on a personal basis, I think there's probably two things that I picked up over the years. The first is more humility. I think oftentimes when we take on a new role, we are so eager to prove to everybody why that was the best decision that they've ever made that we don't take the time to actually listen instead of immediately acting, assuming that we're going to be the smartest person in the room. And that's not the case. And I think what's happened over the years, and especially as we brought the businesses together, the idea of sitting back, thinking about how does the organization work currently, assuming that many things were actually going right, that you're not there to correct a massive problem. At least I've been fortunate enough to do that in the past. There's usually something that's already working. So by having the humility to listen first before acting, I think that's part of it. The second, I would say, is actually related to that, and that's flexibility. Another thing that happens early in your career is in my case, I would feel that if I changed my mind, I would be seen as weak or indecisive. But I think it's actually the opposite. By taking in new information and then acting on that information and adjusting your strategy, oftentimes you have a much higher probability of things going well. And it's that immaturity that comes with it. Again, the insecurity of being new and trying to prove to everybody that it was the best thing that they've ever done when they hired you usually feeds those two things. And that usually ends up poorly by either being too rigid or being too arrogant in your approach.
I mean, two amazing examples there, humility and flexibility, as we think about those as a North Star going forward. Maybe pivoting to the market. The economic and market environment has changed dramatically in the past decade. We've moved from an era of ultra low interest rates to today's higher inflation and rising yields. Have these shifts changed the way you lead RBC BlueBay to create value for your clients? And if so, how?
Well, if I look at the way I lead, the way I lead has not shifted. I mean, I focus on three things as CEO. First of all, the overall strategy of the organization. And I'll talk about a little bit about how we pivoted that. The second tends to be clients, and that's evergreen. And the third is really, which underpins all of this, is culture. And creating the right appropriate culture is creating a culture where you are setting the platform for others to succeed. Now, if I step back and I look at what's changed in the marketplace, where we started as a hedge fund firm as BlueBay, integrated and picked up equities, and so we weren't just fixed income when we integrated with RBC. What's changed right now is we've gone from an environment of, as you mentioned, ultra low interest rates. We used to run around and talk to clients and say, there is no fixed income in fixed income right now. The rates were so low. And that's one of the reasons that we grew our long only business, our traditional asset management business over the last 10 years is a result of interest rates going in one direction. Now that we've got much more volatility, much more activity, it actually plays to the strength of our heritage as an active fixed income manager using an array of different tools. So for us, this has worked out well. And what's been kind of the cherry on top has been the fact that politics and policy are at the forefront. And we've always had a very strong macro thematic that goes through our fixed income management. So being very close to policymakers, which you have the ability to do, especially in fixed income, has given us an edge, especially in areas like emerging markets. We're very active in many of those markets and very close to policymakers. So that's given us a real edge in the markets that we're investing in right now.
Super. So, Eric, turning to the asset management industry, which in itself is in flux, we hear about rising costs, heavier regulation, fee pressures, and lots of consolidation. How do you view these industry challenges, and how do you see the asset management industry over the next 5 to 10 years evolving and shaping and changing?
Well, we've talked at any industry conference that I would go to with senior leaders. We've probably been talking about this for the last 15 years, that you were going to see some sort of shakeout in the industry and that scale was going to be required. So there's a lot of conversation that if you were caught in the middle, you were going to be squeezed out. And I think three things have really created the catalyst for this actually to finally take place. I'd say the first is going to be regulation. The regulation, I mean, the proliferation of regulation, especially post-Brexit here in Europe, has created a completely different cost dynamic for smaller firms. Your ability to be able to manage and then distribute both in the UK and throughout the rest of Europe is very different than it was pre-Brexit, where UK was the gateway to much of Europe. It's no longer the case. You've got to run a management company or figure out how to manage around that. And you typically have to have substance on the ground. So the costs related to that and managing two regulatory regimes, I think, is something that for smaller firms is quite a burden, and it's something you have to get right. The second has been ESG. ESG is something that has come in as a difference in the way we manage money for some organizations. But more importantly, the interpretation, there is no one definition. So you have to be very flexible and be able to adjust depending on what the client is requesting. So with that complexity comes additional cost. And the third, and I think this is really almost the tipping point, is kind of the dual technology front of both AI and cyber. Both of those things are going to require quite an investment, one on the cyber side to protect the organization's information. And then secondly, to be able to take advantage of the benefits of AI, you're going to have to invest first. So if you look at how the industry is set up, if 10 years ago the tide was rising for most people and the barriers of entry were relatively low, it's a very different dynamic today. So scale is required. The second thing that's happening, as I mentioned previously, is you're seeing a convergence between alternative and traditional asset managers. And on the traditional side, there's some real struggles going on there as a result of fee pressures when we did see very low interest rates. So fees were readjusted down and they're not being readjusted up. The second is in both cases, both alternative and traditional firms are going to have challenges. Alternative shops set up to be able to go into a financial institutions channel is very different than their historical client base. And on the flip side, for traditional firms, the culture of an alternative shop is very different than what they typically have in play. And so harmonizing those two things within a business and then being successful in supporting your clients those are some significant challenges that'll take place. And I think those firms that can overcome those will be successful going forward with scale. Those that can't, I think, will end up being either acquired or go out of business.
Thanks, Eric. And if we pivot that slightly and move to the opportunities in the asset management industry going forward, how would you summarize those and where do you think the biggest opportunities lie?
I'd say it's the flip side of the things that I said out of risks. So if you can capitalize on that, first of all, if you look at the changes taking place with many of the large distributors, so I'll use financial institutions as an example, but I'd say the same probably takes place with consultants and also institutional clients, institutions being kind of B2B. In every one of the cases, they too are stretched from a resource perspective. They too have to run more and more efficiently. So faster and faster just to stand still. So as a result, they need to start rationalizing the number of asset managers that they're doing business with. So they want to do more with fewer. At the same time, they're requiring more customization because the complexity of their portfolio requires them to have very precise solutions that sit inside of a portfolio instead of off-the-shelf products. So those two things have changed the dynamics. So one, you need scale. You need to be able to support clients where they're doing business. And secondly, you have to be set up as an organization to have the flexibility to be able to create solutions for your clients. If you can do those two things and you can stay inside the tent, I think it provides a huge opportunity for asset managers that succeed. If you're on the flip side of that and you don't have the kind of flexibility as a platform and the range of solutions, and you don't have the scale to be able to support your clients in the markets that they go to, I think it's going to be a very difficult time for you.
I completely agree. And I think the next 3 to 5 years especially will certainly test some of those theories out.
Agree.
Eric, you mentioned when you were talking about some of the challenges AI, and maybe we can double down a little bit on that. How do you see data and AI shaping the financial services industry? And do you think AI specifically has a role in asset management?
Absolutely has a role in asset management. And for us, one of our strategic priorities this year is to ensure that everybody is AI educated and competent. And I think it's going to be part of the issue because you can have wonderful tools, but if no one's using them, you're not going to get anything out of it. But if I break it into a couple of different component pieces, the way we're looking at approaching AI is, first of all, leveraging the internal resources. Borealis, the organization that RBC owns, invests countless millions and probably billions into technology generally. And there are areas, especially around efficiency, that we want to be able to take advantage of the work that the bank is doing. The second is by utilizing or buying off-the-shelf solutions for certain component pieces of our business. Typically, if you look at it, it could be in the client servicing area or client responsiveness area or reporting, RFPs, that type of thing, where you create efficiency, more robust, and it's very much fit for purpose. The third is going to be build. And the build area is where you're going to get investment differentiation. So where we're going to spend time very much looking at how do we improve the output of our portfolios. And in this case, it's going to be man plus machine instead of replacing man or woman with machine. So that's the way we look at using AI. So leverage internally, buy off the shelf where the solutions make sense, where they're going to have a clear advantage, and then build to get a competitive or differentiation in our portfolio management.
And now, Eric, turning back to RBC, we often talk about how working as one RBC, we can leverage the full capabilities of the group for our clients. RBC BlueBay now sits under the same roof as RBC Capital Markets here in our London headquarters. How does being part of a global brand like RBC, working closely with all internal groups, help deliver successful outcomes for your clients?
Well, there's complexity that comes with size, obviously, but there's also certain benefits if you choose to take advantage of them. And I think previously we were based in the West End, so in Mayfair, and then moved into the offices. And looking at it before we moved, I didn't really see the advantages of being inside the office here. Now they're crystal clear to me. It's incredible to be able to work with the leaders of the capital markets group, with investment banking, with wealth management. We see each other in the hallways. We can have quick conversations. A lot happens when you engage with others. And I think there are really two benefits. One, to the clients, because this kind of creativity, kind of the spark happening here, can take place in areas that you don't expect. And we have a European Executive Committee where we formalize this a bit, but there's also the informal conversations, just getting to know people. You do business with people you like and you trust. The second piece, though, is really the benefit to our employees. And as a smaller organization being integrated into a much larger one, there are offerings that provide value and opportunities to our employees that they never had being part of a standalone part of the business. So now you can see cross-pollination, people moving from one group into another, career opportunities that they just never had in the past. And I think those are some of the benefits, especially for people in the earlier mid part of their career, that they wouldn't see if they were in a standalone business. And they do see being closer together and being in the same building in this case.
Eric, that truly is the power of one RBC that I think we see every day, certainly supported by a lot of sparks and ideas flying around. So thank you for that. And staying on the RBC topic, we've had a fantastic summer hosting new interns and graduates as they take their first steps in their careers. What advice would you give to those who are starting out? And is there any advice you received early on which still influences you today?
Yes, I think this was the one piece of advice. At first, when I heard it, it didn't really resonate. I didn't know what they meant by this, but they said if you do one thing in your career, it's focus on making your boss's life easier. And at first I thought, well, does this mean I have to be a sycophant or something? And just all I'm doing is trying to make their life easier by showing up. The reality is if you think of your boss, their job is to make their boss's life easier. And it goes all the way up the chain. And it starts with the strategy of the organization and it works its way down. So if you make their life easier, if you help them execute on their strategic objectives, life will go well. If you make their life more difficult, eventually things are going to end poorly. So it's very easy to align. Just ask yourself as you're going to your boss, is this going to make their life easier or is it going to make it harder? And if too often you're making it more difficult, chances are things are not going to end well for you at that particular organization. The second is just continuous learning. I mean, I read all the time. You can never stop. You can always pick something up and then continue to evolve. So as I mentioned on the decision-making process, new information, adjust your approach. That should go to yourself as far as your own self-development as well. So I assume with those coming into the business, it's a habit you want to get into for the entirety of your career.
I mean, what fantastic advice to everybody listening. Make your boss's life easier and continue learning. You look at athletes, they have to train every day, and that's how we need to go about our day as well. So, Eric, as we wrap up, a huge thank you for such an insightful conversation on the current asset management landscape and for sharing your personal career anecdotes and top tips. And to all of you listening to Partner of Choice, an RBC Capital Markets podcast, recorded on Thursday, the 6th of November, 2025. If you enjoyed this episode, please share it with your colleagues and peers, and we will see you next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.